Hello, this is Japanese Economic Review Channel. Imagine watching the stock market jump, like 2,500 points in a single afternoon.
Oh, it was absolutely wild.
Right. Only to look at your portfolio by Friday and realize you've essentially just been running on a high-speed treadmill for a week. Today, we are decoding that absolute chaos.
Yeah, because it definitely feels like chaos if you're just looking at the surface.
Exactly. So, welcome to another deep dive on the channel into a newly published, highly anticipated report. Specifically, we're looking at the English translation of the Domestic Weekly Outlook for the week of August 3 to August 7, 2026.
It really is kind of the perfect moment to be dissecting this specific published data. I mean, if you've been watching the trading screens this week, you know the exact sense of whiplash we are talking about.
Oh, 100%.
The market is just trying to process this monumental amount of conflicting information all at once.
And that is exactly our mission for this video broadcast. We're not here to share our personal trading notes or, throw out random hot takes.
Right, leave that for social media.
Yeah, exactly. We are anchoring ourselves firmly in the published Domestic Weekly Outlook to help you cut through the extreme market noise. We want to help you understand the actual underlying fundamentals driving the Japanese economy right now.
Because there's a lot going on under the hood.
There really is. So let's start by contextualizing the big swing leading up to Friday, July 31st, 2026.
Right, well, let's just look at the actual close. The Nikkei 225 ended the week at 64,362.02. And just to round out the broader equity picture, the 2APX closed at 4,003.30.
But I mean, those closing numbers are almost deceptive, aren't they?
Oh, highly deceptive.
They don't tell the story of the sheer turbulence it took to get there. Like on July 31st, the index jumped roughly 2,500 points in a single day.
A historic move.
It was an absolute rocket ship of a trading session.
Yeah.
Yet, despite that massive one-day surge, the index ended the week basically flat. In fact, it was actually down about 249 points from the previous week. Okay, let's unpack this.
Let's do it.
Why are we seeing this massive level of turbulence? Like, what is the actual mechanism causing the ground to shake like this?
Well, according to the published findings in the Outlook, the epicenter of this earthquake is squarely in the AI and tech sector. The report points to this massive structural shakeup among the hyperscalers.
Okay, just to make sure we're all on the same page here. Hyperscalers are those massive cloud and internet giants, right? Like the ones buying up all the cutting-edge semiconductors to build out their artificial intelligence capability.
That's them. Yeah, they are the architects of the global AI infrastructure. But the report highlights that these hyperscalers are facing mounting, almost crushing financial burdens right now.
Because it's not cheap, right?
No, not at all. Building an AI ecosystem isn't just about, buying a chip. These companies are pouring tens of billions into massive data center investments.
Right.
We are talking about acquiring the real estate, securing the massive amounts of power required to run them.
Which is a huge bottleneck right now.
Exactly. Plus the advanced liquid cooling systems and, of course, the actual silicon itself.
And they aren't just operating in a vacuum either. The Outlook notes rising. Fierce competition from Chinese tech firms pushing into the same exact space, right?
Right. So you have these skyrocketing capital expenditures colliding with multiplying global competitors. And that specific combination is what's fueling these sudden AI bubble burst fears in the broader market.
It's spooking everyone.
It really is. It's accelerating a rapid flight of capital away from semiconductor stocks. Institutional investors are looking at the billions going out the door in capital expenditures and asking a very basic, very ruthless question.
Which is?
When is the return on investment actually going to show up on the balance sheet as profit?
Yeah, that makes sense. I kind of look at it like this. The AI sector was this gleaming high-speed bullet train. Retail investors, pension funds, hedge funds, everyone jumped on board over the last 2 years because of the sheer speed and, the promise of this utopian destination.
Right, the hype was undeniable.
But right now, it feels like the passengers are suddenly looking out the window, staring at the meter, and realizing how astronomically expensive the fuel is.
That's a great way to put it.
The cost to keep the train moving is staggering, so they are scrambling for the exits to lock in their profits. But the irony is, the train is still moving forward perfectly fine. Like, the actual business models haven't collapsed.
I think that captures the sentiment perfectly. And it aligns directly with the data, too. What's fascinating here is that the underlying business conditions haven't actually decayed at all.
Really?
Yeah, the Outlook clearly states that the actual business environment for these tech giants remains robust. They are still growing. But the volatility itself, the panic of passengers running for the exits, has become a self-fulfilling problem.
I want to dig into that, actually, because I think it's a crucial point. How does the volatility actually become the cause of more panic?
It comes down to how institutional money operates. The report explicitly calls out that the Nikkei's daily trading range has been exceeding 2,000 points on a 5-day moving average.
Which is just massive.
It's unprecedented for a lot of these funds. When a market swings that violently, you fundamentally change its risk profile. Medium to long-term investors. So the massive pension funds, the university endowments.
The ones that usually keep things stable.
Exactly. The institutions that provide the baseline stability and liquidity to a market, they have strict legal and procedural mandates regarding risk. We call it value at risk.
Right.
When the daily variance exceeds their mandated thresholds, their risk models physically break. They are forced by their own algorithms and compliance departments to liquidate positions and step back from the market to reduce exposure.
Wow. That is a massive takeaway. So the volatility isn't just a symptom of a panicked market.
No.
It mathematically forces the stabilizing money out of the room.
Precisely. And when the long-term stabilizing money steps back, who is left in the room?
The day traders.
Short-term, high-frequency traders and momentum algorithms, those participants don't care about the long-term viability of AI. They trade on the immediate momentum of the swing, which of course only amplifies the 2,000-point drops and spikes. It is just a vicious mechanical cycle.
So the institutional stabilizers are sitting on the sidelines and the disruptors are running the show.
Yeah, pretty much.
This institutional panic clearly isn't contained, though. We need a way to break that cycle. How do we transition from this hype-driven, macro-level volatility back to something resembling reality? Like, what brings the stabilizers back into the room?
Hard data.
Hard data.
Yeah, we have to shift our focus to the micro-level numbers, the data that actually grounds the market, which is corporate earnings. The narrative has carried the market as far as it can. Now the math has to take over.
And the timing on that is essentially right now, isn't it? The outlook details that domestic corporate earnings are hitting their first major peak on July 34, with the grand finale of earnings season coming up next week on August 7.
Yes. This earnings season is going to act as a massive reality check. I would compare this upcoming week of corporate reports to, like, a stress test for a newly built bridge.
Okay, I like this.
The AI narrative, all that excitement, that's what funded and built the bridge. But these earnings reports are the heavy commercial trucks driving over it to see if the steel actually holds.
And the report suggests that some of these companies are going to crack under the weight, while others are going to prove they're structurally sound.
That's the core of the analysis, yeah. On one side, you have the hype stocks. These are the companies that rallied purely by associating themselves with AI, but they don't actually have the revenue growth or profit margins to back up their inflated valuations.
Like the tourists.
Yes,
Yeah.
exactly. The outlook warns that these specific stocks face severe exhaustion selling risks.
Meaning investors who bought at the top are just, what, exhausted from holding the bag?
Basically, yes. Retail and institutional investors alike have held on through the volatility, hoping that the earnings report would magically justify the high stock price.
And when it doesn't?
When the company misses its revenue targets, that hope evaporates, and the capitulation, the selling pressure, is going to be immense and rapid.
Ouch. But there's a flip side to this stress test.
No, absolutely. Companies with genuinely solid business conditions, the ones producing real cash flow, maintaining their margins despite inflation and capex costs, they are going to see their stock prices reassessed very favorably.
So money will flow to them.
The report anticipates a violent flock to quality. The market is desperate for certainty right now, and it will reward the companies that actually provide it.
I have to push back here for a second, though, because I look at the screen and I just see macro panic. Are we really shifting from a narrative-driven market to a numbers-driven market right now?
It's a tough transition.
Right, because even if AI semiconductors, the companies actually designing and fabricating the chips, prove their worth and post incredible earnings next week, will that really act as an anchor heavy enough to stop these wild 2,000-point daily swings? Or is the macro fear just too loud?
It's a very fair challenge, and it's the exact tension the market is grappling with. But according to the Outlook's analysis, yes, an accumulation of positive, hard data from individual companies is exactly what is needed to calm the broader market.
Accumulation being the key word.
Right. A single good earnings report won't do it. But an accumulation of them, especially in that critical semiconductor space, creates a floor. It gives those medium and long-term investors we talked about earlier the mathematical justification. Their risk models need to step back into the market and buy the dip.
That makes sense.
That accumulation of hard evidence is really the only known antidote to macro sentiment.
Okay, so corporate earnings are the ultimate anchor for equities. But this institutional panic isn't contained to the stock market. If foreign capital is fleeing Japanese tech stocks, that money has to go somewhere, which, immediately bleeds into the currency markets.
Oh, the Forex market is experiencing its own intense whiplash.
It truly is. To understand the sheer scale of the chaos, we need to look at the numbers as battlegrounds. In the early hours of July 31, the report cites the USD-JPY rate at 157.81 and the EUR-JPY at 181.63.
And that 157.81 number is fascinating when you consider where we were just a day prior.
Exactly. To really grasp how wild this is, we have to look at the yen's tumultuous timeline over just a few days. Let's start with Tuesday, July 30th. We saw the yen drop below 158 to the dollar. In the currency world, that is a massive, incredibly sudden appreciation of the yen.
Huge move.
The outlook points to suspected massive government intervention as the driver there. How does that actually work mechanically?
So when you see a move that sharp and that vertical in the currency markets, the immediate conclusion drawn by market participants and reflected in the report's analysis is that authorities stepped in.
Right.
Mechanically, this means the Ministry of Finance directed the Bank of Japan to use its foreign reserves. They sell massive amounts of US dollars into the open market and aggressively buy Japanese yen.
And that just jolts the price.
Yeah, this sudden flood of demand for the yen spikes its value instantly, which heavily punishes speculators who are betting against it.
But it's a blunt instrument, right? Because almost as quickly as it spiked, we bounced right back to the upper 160 range on July 31st. This whiplash happened right after the Bank of Japan, the BOJ, concluded its policy meeting and left policy rates unchanged.
Yes. Interventions can scare speculators temporarily, but they don't change the underlying mechanics of the economy. The market loves to build up expectations heading into central bank meetings.
Always.
But the BOJ delivered a no-surprises event. They held the line on rates, and because there was no hawkish surprise, no immediate interest rate hike to narrow the yield gap with the U.S., the structural pressure returned, and the yen weakened again.
So the fundamentals took over again.
Exactly. But to be clear, central bank moves are only half the story for the currency right now.
Yeah, the external pressures are mounting heavily. Let's get into the geopolitical and domestic factors swaying the yen.
Geopolitics is playing a massive immediate role. The report highlights the ongoing U.S. and Iran tensions. Earlier in the week, those tensions briefly appeared to ease.
Now, why does that matter for the Japanese yen specifically?
Good question. When Middle East tensions ease, global oil prices tend to drop because the threat to supply chains diminishes. Japan imports virtually all of its energy.
Right, they rely on that oil.
So cheaper oil means Japan doesn't have to sell as much of its own currency to buy the US dollars needed to import that oil. So easing tensions naturally relieves downward pressure on the yen.
It's incredible how directly a headline out of the Middle East dictates the purchasing power of the yen. But that easing didn't last long at all, did it?
Not even a few days. The tensions flared right back up. We saw attacks on U.S. bases in the region and former President Trump publicly promising severe retaliation.
Yeah.
The geopolitical risk premium instantly shot back up, oil prices reacted, and the heavy pressure on the yen returned.
And it isn't just international politics throwing their weight around. Domestic politics are creating their own waves. The Outlook specifically discusses the Takaichi administration's proposed food consumption tax cut.
Yes, it's a major talking point.
And just to be crystal clear for you watching, our goal today on the channel isn't to take a political stance on the Takaichi administration's policies. We take no political sides here. We're strictly reporting the published Outlook's analysis of this. We're simply acting as a mirror, showing you exactly how the bond and currency markets are reacting to the math behind this proposed tax cut.
Which is an important distinction to make, because from a purely market mechanics perspective, the report explains that bond and currency traders are viewing this proposed tax cut as a source of fiscal anxiety.
Wait, a tax cut usually stimulates spending, right? Which markets tend to like.
Yeah.
But bond traders are viewing this as anxiety because they're looking at the government's balance sheet.
Exactly.
If they cut taxes without cutting spending, how does that mechanism play out?
You've hit the nail on the head. It all comes down to government revenue versus debt. A cut in the consumption tax, even just targeted at food, means a significant immediate reduction in the tax revenue coming into the government's coffers. Right. If revenue falls, but government spending remains static, the deficit grows. The market assumes the government will have to issue more Japanese government bonds, more debt to cover that shortfall.
And more supply bonds usually means their prices drop.
Yes, and more importantly, the prospect of increased debt issuance makes foreign investors nervous about Japan's overall fiscal stability.
Oh, I see.
When international investors get nervous about fiscal health, they sell Japanese government bonds, and by extension, they sell the yen to move their capital elsewhere. It is a chain reaction driven entirely by fiscal expectations.
So we have the BOJ holding rates steady, geopolitical oil price pressures acting as a massive tax on imports, and domestic fiscal anxiety all creating this incredible turbulence for the yen.
If we connect this to the bigger picture, it all fundamentally anchors back to central bank divergence. The BOJ held rates, though it is worth noting the nuance here. Governor Ueda explicitly warned of upward inflation risks during his press conference.
So he's not ignoring it.
No, he is signaling to the market that they are watching prices very closely and aren't afraid to act if inflation accelerates. But across the Pacific, the U.S. Federal Reserve's FOMC, the committee setting U.S. rates, also held rates this week.
However, the tone from the Fed is very different right now, isn't it? They're openly eyeing a rate cut as early as September.
And that tone shift is critical. But here is the reality the report emphasizes. Despite the BOJ sounding a bit more hawkish on inflation and the Fed looking toward a cut, the fundamental numerical interest rate gap between the U.S. and Japan remains stubborn.
It's still huge.
It is a massive gulf. As long as an investor can get a significantly higher guaranteed yield holding U.S. dollars compared to Japanese yen, global capital will naturally flow toward the dollar.
That's just math.
Exactly. That structural, mathematical reality is why the report anticipates the dollar-yen will remain confined in a rather elevated expected range, between 157.90 and 163.00 in the near term.
The gravity of that interest rate gap is just too strong to be easily overcome by one-off interventions or subtle shifts in central bank rhetoric, which leads us perfectly into the immediate future. As we look at the calendar for the week of August 3 to August 7, what do you, the viewer, need to be paying closest attention to?
You need to have your eyes locked on the United States labor market.
Really? The labor market?
Yes, the upcoming U.S. employment data is going to be the ultimate stress test for the global macro narrative. We have the ADP employment report coming out on August 5.
And the ADP report tracks private sector payrolls, right? It kind of gives us an early sneak peek under the hood of the U.S. economy before the official government numbers drop.
Exactly. It's the appetizer. The main course is the critical non-farm payrolls report published by the U.S. government on August 7.
Why is the U.S. labor market the linchpin for everything we've talked about today, from tech stocks to the yen?
Because it dictates what the Federal Reserve does next. If the U.S. labor market shows robust health-like, if job creation is strong and wages are stable without spiraling out of control, it will spark widespread optimism about the resilience of the U.S. economy.
Okay.
If the economy is resilient, the Fed doesn't need to aggressively cut interest rates to save it. If the Fed doesn't cut deeply, the U.S. dollar stays strong, which maintains that yield gap we just discussed, keeping the yen under pressure.
But what if the data misses?
Conversely, if the U.S. jobs data comes in terribly weak, the market will instantly price in rapid emergency-style rate cuts from the Fed.
Oh, wow.
The dollar could weaken dramatically, and the yen might suddenly rally. Everything hinges on those specific jobs numbers because they dictate the cost of capital globally.
And as for the domestic equity market, despite that massive U.S. jobs data looming over everything, the outlook provides a very specific forecast for the Nikkei's 225 next week. The report projects a trading range of 61,500 to 66,500.
Which is a staggering 5,000-point band.
It's huge.
It perfectly encapsulates the volatility and the total market indecision we've been discussing. The report is essentially acknowledging that the wild swings are absolutely not going away next week. The bulls see the path to 66,500 if AI earnings hold up, but the bears see the floor at 61,500 if the U.S. jobs data triggers a recession panic.
Okay, let's unpack this. So what does this all mean? If I'm watching this right now, trying to make sense of a 2,500-point daily swing, a currency that jumps from 158 to 163 and back again, and a massive 5,000-point forecasted range for next week, where is the signal in all this noise?
It's hard to find.
For me, the takeaway from this report is that you have to watch the collision of two massive forces next week. On one hand, you have the heavy-hitting micro-level corporate earnings. We are talking about the absolute titans of Japanese industry publishing their numbers between August 4 and August 6, Toyota, SoftBank, and Nintendo.
Heavyweights.
Right. These are companies that don't just participate in the market, they define entire sectors. On the other hand, you have these massive macro crosscurrents. The U.S. jobs data, the geopolitical tensions in the Middle East, the BOJ's inflation warnings.
It's a lot hitting all at once.
So the true signal is going to be how those solid company earnings interact with the macro panic. If Toyota and Nintendo post incredibly robust numbers, do they get dragged down by U.S. jobs data anyway? Or do they act as the heavy anchor that stops the market from sliding further into that 61,500 territory?
That tension raises an incredibly important question, actually, and it's something the report subtly hints at in its conclusion. If we can look past the immediate panic of next week's 5,000-point range, we have to ask ourselves about the true long-term nature of this current market volatility.
What do you mean?
Well, if the market is currently engaged in the painful but completely necessary process of weeding out the hype from the real in the AI sector, punishing the hyperscalers for their unsustainable capital expenditures while rewarding the traditional companies with actual durable cash flows, perhaps this 2,000-point daily volatility isn't actually a crisis at all.
Oh, wait, that's a bold statement. How can a daily 2,000-point swing, which is literally breaking institutional risk models, not be a crisis?
Because it might be the necessary healthy reset required for the next decade of investing.
A healthy reset.
Yeah. Markets occasionally have to flesh out excess speculation to build a durable foundation. The capital that is currently fleeing the AI hype train isn't just evaporating into thin air. It has to go somewhere.
True.
If that capital finds a new home in traditional undervalued sectors, companies that have been completely ignored for the past 2 years while everyone chased the AI shiny object, we could see a total reshaping of market leadership by the end of 2026.
Yeah.
What feels like chaos might just be the friction of money changing hands from the dreamers back to the realists.
That is an incredibly provocative thought to leave off on.
Yeah.
Is the current chaos just a healthy, if painful, reallocation of capital? Will the end of 2026 look completely different in terms of market leadership because of the pain we are experiencing this week? It's something you watching will definitely want to mull over as we head into what is guaranteed to be a historic week of trading.
Definitely keep an eye on it.
Thank you for watching the Japanese Economic Review. We look forward to having you with us again.